Bitcoin just lost 18% in 3 weeks. Pause. Retail investors are panicking, liquidations are stacking up, and crypto Twitter is doing what it always does, screaming that the sky is falling. But here's what nobody's talking about. While you're watching red candles, Wall Street just moved $2.3 billion into a completely different crypto category, and they're doing it quietly, on purpose. By the end of this video, you'll understand exactly what institutional money is buying, why they're ignoring Bitcoin's price action entirely, and how this shift could reshape your portfolio strategy for the next decade. Let's get into it. First, let's kill a myth. Pause. Bitcoin crashing doesn't mean institutions are leaving crypto. It means they're repositioning. See, there's a difference between retail behavior and institutional behavior. Retail sells when prices drop. Institutions, they rotate, and right now the rotation is aggressive. BlackRock, the largest asset manager on the planet with $10 trillion under management, just expanded their blockchain division by 40%. JPMorgan processed $1.5 billion in tokenized transactions last quarter alone. Goldman Sachs launched 3 new digital asset products in 60 days. These aren't experiments, these are strategic bets. So what are they buying if it's not Bitcoin? 2 words, tokenized assets. Pause. Stop thinking about crypto as just currencies. That's 2017 thinking. The new Wall Street obsession is putting real-world assets, real estate, bonds, private equity, commodities onto blockchain infrastructure. It's not sexy. It's not a meme coin, but it's projected to become a $16 trillion market by 2030, according to Boston Consulting Group. $16 trillion. To put that in perspective, the entire cryptocurrency market cap right now is hovering around $2 trillion. We're talking about an 8 times expansion, not in speculative tokens, but in digitized versions of assets that already exist and already have value. Now here's where it gets interesting. Pause. There are 3 specific sectors absorbing the most institutional capital right now. Sector 1, tokenized treasury bonds. Boring? Absolutely. Profitable? Ask BlackRock. Their BUIDL fund, a tokenized treasury product, crossed $500 million in assets faster than any ETF launch in their history. Why? Because institutional investors can now hold US government debt on blockchain rails, earning yield with 24/7 liquidity and instant settlement. No more waiting 3 days for trades to clear. No more banking hours, it's treasury bonds, but optimized for the digital age. Sector 2, private credit tokenization. This is the shadow banking system going on-chain. Companies like Figure and Centrifuge are tokenizing private loans, allowing institutional investors to access yield opportunities that were previously locked behind minimum investments of $10 million or more. Fractional ownership of debt instruments. It sounds technical because it is, but the money flowing here is staggering. Over $8 billion in active tokenized credit as of last quarter. Sector 3, real estate tokenization. Pause. This one's been promised for years, but it's finally happening at scale. Platforms are now allowing fractional ownership of commercial properties, office buildings, apartment complexes, industrial warehouses, with liquidity that traditional real estate could never offer. You want to own a piece of a Manhattan high-rise and sell it at 2 a.m. on a Sunday. That's now possible. But here's the pattern interrupt you need to hear. Pause. Not every tokenization project is legitimate. In fact, most aren't. For every BlackRock-backed initiative, there are 50 projects using the word tokenized as marketing fluff with no real institutional backing, no regulatory compliance, and no actual assets behind the tokens. So how do you separate signal from noise? 3 filters. First, who's the custodian? If there's no regulated, audited entity holding the underlying assets, walk away. Second, what's the regulatory status? Projects operating in clear jurisdictions with proper licensing are the only ones institutions will touch. Third, where's the liquidity? A tokenized asset with no secondary market is just a certificate with extra steps. Let me be blunt. Pause. Retail investors lose money in crypto because they chase narratives instead of following capital flows. They buy what's trending on social media instead of watching what's happening in SEC filings and institutional announcements. The next 12 months are going to separate 2 groups. Those who understand that the crypto market is bifurcating speculative assets on one side, institutionally backed digital infrastructure on the other, and those who keep waiting for their altcoin bags to pump. Bitcoin isn't dead, it's just not the whole story anymore. Pause, the smart money has already moved. The question isn't whether tokenization is the future. The question is whether you'll understand it before or after the opportunity matures. If this breakdown gave you clarity, you're not getting anywhere else. Subscribe. I release one video per week on institutional capital flows, market structure shifts, and the financial trends that actually matter. Hit the bell so you don't miss the next one. I'll see you in the next video.